Hello, me. Let's do the trade review for today. So this is October 17. We're trading NQ December contract, and we are on the daily chart. So let's review what happened today. Today was a very interesting day. There's a lot of manipulation. It was a strong bearish day, especially in the New York session. So let's talk about what happens and understand why price went to the levels that it went to. What's the reason behind it, so that we can improve our trading. This is a video for me as much as it is for anybody who finds it interesting. I treat this as my own personal journaling, because I think I learn best when I'm explaining things to people. So this is kind of like my own development, and also for people who might find it beneficial also for them, to help them understand and improve their reading of price. So let me just remove those. So starting with the daily chart, the obvious PDRAs that we can see in the daily chart, we have here, let me see if I can annotate. That would be very nice if I can do that. All right, that's good. Let me just move it a little bit here. So we have here this fair value gap here on the daily. Fair value gap. It's in the form of a CB, right? And that's what we have highlighted here in this color. This one. This is the fair value gap that we have, right? And we have also this level right here, and this is yesterday's high, right? This is yesterday's high, and we can see how price pierced through it in the New York morning session, and we will get into more details when we drop down to the lower time frames, the 1 minute chart. We will see this in more detail, because it was very interesting how price tagged into previous day's high, filled this daily fair value gap in the form of a CB before dropping down. We will see that. So what we have here highlighted in this line, I just want to show you this because when we drop down to the 1 minute, you can understand what these levels refer to, right? And we have here the previous day low, which was the draw on liquidity for today, the final draw on liquidity for today. So that's what you need to know about the daily chart. Now let's drop down to the hourly, because it shows something very illuminating. So I'll just try to delete this and drop down to the hourly. It's just an amazing manifestation of power of three. So power of three, for those of you that don't know, power of three is accumulation, manipulation, and distribution. Okay, so look at here. Look at here. This is this happened during the Asian and London sessions, and what you can see here is the first phase of power of three, which is accumulation, right? And what do you see here? This will become more evident when we drop down to the lower time frames. It will be more evident. See how we tagged into the previous day high. We run on stops. This was a run on buy side liquidity, right? Before we drop down. So this is manipulation. This was meant to manipulate people into taking longs before it reverses on them. And also, when we tagged the shorts here, right? This was for people who were trying to go short, before the distribution. And this will become much clearer when we drop down to the lower time frames. So we have here accumulation, here we have manipulation, and here we have distribution. This is distribution. All right. So I want you to see it from the 1 hour because it's much clearer, because in the 1 minute we have more details, we have more candles, but in the 1 hour it's a beautiful manifestation of the power of 3 today. All right. So now let's, this is very annoying. Let me remove this. Now let's drop down to the, let's remove this. Let's drop down to the 1 minute. So here we opened right about here. Right about here. This was where we opened. Let me get that right. Okay. We opened right about here. This was the AM session, the start of the AM session. And we pretty much consolidated, for about an hour, right? And at exactly 10:30, so most of the hour was only consolidation, and at 10:30 we started to have some movement, right? And look at how price manipulated people into going long, for those who were thinking, and maybe the market is gonna make a new all-time high, or maybe it was going to fill that collapse of price during last Friday. So people were thinking maybe we're gonna recoup all of what we during that collapse during Friday. But what happened is that the market regained a lot of that loss on Friday. It filled the whole daily fair value gap that we saw before, right? But for people who were having that idea, right, like smart money manipulated them into going long before it reverses against them, and pretty much price fell out of bed afterwards. So see how there were people who were going short. They were going long here. I'm sorry. There were people who were trying to go long here during this movement, hoping that the market is going to be bullish, right? And and look at what price did. It manipulated them here. On the other hand, there were also people who were trying to go short prematurely. Where do they place their stop losses? Here and here. And look at this run on stop initially, right? This one. This made people who were placing their stop losses here feel safe, and then the market just reverses around them. Took the buy side liquidity here, tagged into the previous day high, filled the daily fair value gap, and it did pretty much all the work here before starting the third phase of power of 3, which is distribution. And see how that happened very, very nicely here, right? Now, previous day high is tagged into. We tagged into the like orders, buy orders and sell orders, right? In this area, right? We manipulated like retail traders into taking the wrong side of the market, and now smart money, dropped price. Pretty much, it was bearish for the entire day, right? So I want to walk you through market structure, right? The idea of market structure and how it was useful to understand that price was gonna keep going lower and lower and lower, because there are people who were thinking that this is just gonna be a maybe a run on this sell side liquidity, those relative equal highs here, and then it was going to resume higher. There are people who had that idea. We're gonna talk about market structure and show how there was some clues in the structure, right, of price that gave us the idea that price was going to continue going lower. So let's see that. So you can see here we have this fair value gap and the volume imbalance. I need to zoom in order for you to see it. It's very small. It's very, very small. See how we have this volume imbalance right here. See where the bodies are, right? They respected that volume imbalance along with this fair value gap. So this would have been a nice entry for shorts, right? Targeting what? Initially targeting this low right here, and targeting also these relative equal highs here from the previous day. What does ICT teach us? That smooth edges are made jagged. Well, this is a perfect example of this here. We have these relative equal highs. Price targeted those relative equal highs from the pre-New York session, right? It tapped into it, retraced, and see, I want you to see how whenever price, right, tags into like sell side liquidity, it retraces and then it retraces, right? We did that here. See how we did that here, right? We did that here as well. I don't have this highlighted, but we did that here. So whenever we tap into sell side liquidity, there's a reaction, a retracement, and then resuming going lower. We did that also here when we tapped into the sell side liquidity. See how price retraced into some fair value gap in the form of CB, and then continue the resuming going lower. And we had the same thing here, right? So this would have been a clue that this is just a reaction, right? When tapping into those pools of liquidity resting below here, below here, below here, below here as well, and below here, right? This is the first clue that we were bearish for the day. Price is tapping into those areas of liquidity and then reacting until we reach the previous day low. And you can see it also here. This is the terminus, like the final draw on liquidity, which is the previous day low. Let me change this. Previous day low right here. And see again, once we tapped into it, see how we had this reaction. See the reaction here. Very, very strong reaction. Let me zoom in so that you can see it. Right. This is the level, previous day's low. Look at the reaction we had here. And then we just, meandered around for the rest of the session, right? So that was an enough clue to stay into the trade, not to get out prematurely. If you got into here, this would have been a clue that we're just reacting, right, when tapping into those pools of liquidity. and we're just retracing, and we were still going to go lower, because there are people who are thinking, well, wait, price is going to reverse here, and then they got out of trade prematurely, right? And then here, and then here, and then regretted not catching this very, very big move today. It's a very, very big move. I mean, if your entry was here, and this is what ICT teaches in his 2022 model, right? Some kind of liquidity raid, right? Then break of structure, right? Or shift in market structure, and then retracing into a fair value gap, and that would be your entry. This is like a nice example of the 2022 model of ICT, right? And the other clue that I think gave the bearish bias is the market structure. Look at how the market was constantly making lower lows and lower highs, lower lows, lower highs, right? Very, very annoying. Lower lows, lower highs. Okay, I can keep going. Same thing here, right? Here. So normally when we are bullish, in the market, let me write this. Normally when we are bullish, we're making constantly higher highs, and higher lows, right? Let me just demonstrate. Let's say we are bullish in the market. Market structure show us we're making like this, higher highs and higher lows, right? This is a bullish market structure. But when we have a bearish bias, right, normally we are making lower lows and lower highs, right? So this would have helped us understand that we are just retracing and we're going to resume lower, right, and not get out of the trade prematurely. For those who could read the bias and understand that we will have a bearish day, right? So that's it for this review. I don't want to make it any longer than this. This is my insights from today, what I have learned from today, what I've noticed from today. And I just want to cover this lastly, right? The market, we don't like, this is something to keep in mind. This is something for me to keep in mind and for you, the viewers, right? Like, there are people that see price going down like this and they enter here, or they see price going down like this and they enter here. This is very, very bad. This is very, very bad, because look, if the market reverses, or if you enter here and the price reverses against you here, you're already in big drawdown, and maybe you will get out of the trade because you're afraid to lose even more, right? Same thing here. So we don't chase price, price comes to us, right? And these retracements gives us the opportunity to enter again. If we so let's say we miss this entry right here, this would have been another beautiful chance to enter again. Same thing here. Let's say we miss this entry, we can enter here, we can enter here. So we never chase price, but we let it comes to us. We let it retrace to fill those imbalances during this strong. So whenever we have like a strong drop, very fast drop, we leave like inefficiencies, right? And the algorithm, the market has the tendency, right, to come back and fill those inefficiencies before going lower. So we have here this, see how the market retraced, price retraced, right? Fill this fair value gap plus volume imbalance, right? And resume going lower. Same thing here, same thing here. So like those inefficiencies are not only like points of entries. That's something that you have to understand. It's not like they offer us the chance to have a favorable entry, but also they reveal to us where price is going. So when we see that price respected this fair value gap plus their volume imbalance with the bodies, right? What ICT says, you know, the wicks do the damage, the bodies tells the story. So the wicks are normally just run on stops, right? Something like that, or coloring outside of the lines. That's the analogy that ICT famously gives. But in any case, to put it simply, we have to look at the bodies and how they're respecting those inefficiencies, right? And that helps us if price is retracing and respecting these inefficiencies. This shows us that we are going to continue go lower, right? Look at here. Breakaway gap is when price runs away from the inefficiency and does not fill it. So the fact that we just wicked, you know, through this fair value gap and we couldn't even get to consequent encroachment, which is the middle point of the fair value gap, this reveals to us that we are going to continue to go even lower. Same thing here. Price is respecting this small fair value gap, which I'm going to try to zoom here. So see how we are, all the bodies are below consequent encroachment, right? And that tells us that price is weak. It's really heavy and it's going to drop down, right? Same thing here. Until we get to this level here, right? So inefficiencies, you know, are not just, okay, price filling, coming back and filling this level. They're something to use for entry, and they're something to use for understanding bias, for understanding where price is trying to reach for. So you always have to ask yourself, where's the draw on liquidity? So that's your levels, right? Like previous days highs, short-term highs, relative equal highs, right? Those act as the draw on liquidity because this is where the pool of liquidities are resting, and that's a very strong driver for price. Price is always moving to hunt for liquidity. That's the number one reason, that driver for price, right? And number two, whenever we have a strong movement towards an area of liquidity pool, we leave inefficiencies that the market retraces to fill, right? And how the price fills those inefficiencies tells us that whether we are going to resume going lower to attack another level of liquidity, right? Or we're going to reverse, you know, and attack the other side of liquidity, right? And if we are respecting them, right, we are still bearish in this context. If we're not respecting them, if we are just running into them, right, this shows you that there is likely a reversal coming and you should get out of the trade, right? So I hope this has been useful. I hope this provides you some insight. It certainly did for me, and I learned a lot from today's session, right? I took a trade. It was profitable, but I end up, and this is something that I journaled about. I have this problem where, like when I am in a losing trade, I move my stop loss, hoping that price is gonna basically run away from my stop loss, and that's something that I have to work on definitely. And also I have this problem when I am in a winning trade, I get out like prematurely. So let me, I think I screenshot this. Let me show you the entry, the trade for today. We were more or less profitable, so that's what is important, but these are lessons to learn from. So I kind of like journaled about this, something that I can show you as well. So this was like my profitable trade, right? So this is where I placed my stop loss. I tried not to place my stop loss like really like tight, because we can have a retracement and price is just gonna like tap into your stop loss and take it. So I entered, my entry was here, and I got out here. So I got out once those those relative equal highs were tagged into, because I was thinking that that is the what is the main objective for today. But we really had a really strong bearish move. But I kind of like wanted to get out of here, because I was like thinking that price may reverse right against me, and it did retrace, right? This would have been tough, you know, to sit through. It did retrace, but then price continued to resume going lower. So this is something to learn from. Like never like cut your losses short, right? And let your winners run. And this is something that I've learned from today, basically, and I journaled about it. And this was the first entry. I want to show you this. I hope you can see it clearly. Don't mind my handwriting, because I'm writing with this digital pen and it's really hard to write with. So I want to zoom in to here. So here I knew that we are going to be bearish for the day, right? For many reasons, but I end up entering prematurely. I end up here, entering here, right? And then I put my stop loss here. It didn't take it here, but I got out when price gave me the chance to get out with a loss, because I was sure that we were manipulating here and we are tagging into those stop losses, and I was one of the people that were putting their stop losses here. So I'm sure that there are many people that were doing the same. So the market tapped into those shorts, slaughtered them basically, right, and resumed going. So I waited. I got out with a small loss, and I waited until the price, the market gave me like an entry here. So I got out here, and I entered here and got out here. So it was a pretty nice trade here. I felt like I missed, like I was fighting with myself, because I felt like I missed like the move, and I really believed that we were still gonna resume going lower. So I tried to enter here, right? Then I was like kind of like second guessing, and this is something I journaled about. I was second guessing, like when the market starts moving here, I was kind of second guessing. Maybe we are going to, this is enough for the day, and we are gonna like reverse, right? But we only continued going lower, and I was like fighting with myself, and I had like a lot of regret. Like I got out too soon. I could have captured this move, but this is, hey, these are thoughts that you will have whenever you're trading, and you have to learn to control them. So I fought with myself today. I'm very proud that I didn't chase price, right? And I was like content with the trade that I had, and it was pretty good. So this is something to learn about psychology. Something to learn about money management is that never cut your losses. Always cut your losses short, but never cut your winners short. Like let them run, right? Because you never know what the market is going to give you. You know, you have a target in mind, but you never know like what the market is going to give you. So it's good to, you know, like find that out, explore what the market is willing to give you, and that's plays a huge role in positive expectancy, which is like how many losses that you have and how many winners that you have. So over time, you should, in your statistics, should show that your losing trades, right, are lower, not like in the amount of losing trades, but in the amount of price, right? Let's say you have losing trades with a risk of 300, and you're winning trades whenever you catch a move, you make like 1,000 or 2,000, right? You can have so many losing trades, but you will still come out. You will still come out profitable. And that's the true edge in trading, right? And that can only happen if your losses are small, your winners are big. And that's something that I have to work on. I still have a problem with this. It's something that I have to work on. And it's also good for your psychology that never regret like that you missed a move and try to chase it, because you will just end up giving back everything that you have earned to the market, right? So I don't want to, I already made this video very long. I don't want to make it longer than it is. I hope you guys benefited from it. I certainly did today. I learned a lot of lessons, and I will do my best not to repeat the mistakes that I made today. So until next time, take care.